Hey Brandon, why did my mortgage payment change between the time I got pre-approved and the time I found a house?
That's a great question, Sam. Why don't you come over here and I'm gonna show you why your payment might have changed once you found a home. Okay, Sam, so let's just say you were pre-approved for a $400,000 loan. Let's first look at how you were pre-approved and what those numbers look like. So you have a principal and interest payment of $2,530 per month, and that's at a 6.5% interest rate over 30 years. On top of that, you have property tax. We're gonna say your property tax that they pre-approved you with was $500, and let's just say the insurance that they pre-approved you with was $300. Now you're putting 20% down in this scenario. Let me just put that up here so you guys know. That's why there's no mortgage insurance showing. This means that the payment that they estimated when they did your pre-approval was $3,330 per month. Now you've gone under contract and you're still borrowing $400,000. However, a couple of things have changed. The principal and interest payment is $2,630. Why is it $100 more? Well, that's because rates have increased by 0.25% between the time you got pre-approved and now. So now you're at 6.75%. This is because your rate's not locked when you're pre-approved. It doesn't usually get locked until you go under contract. The house you found has a property tax bill that equals $650 per month, more than the $500. And you received an insurance quote for this specific home that's $360 per month, more than the $300 that they used in your pre-approval. Altogether, your payment on this specific property that you're under contract for is $3,640, right? It's a difference of $310 per month. Now, what's your impact on qualifying with this now higher payment? Well, let's just say that you make $8,000 per month. This is your qualifying income. Well, at $3,330 per month, that would equal a debt to income ratio of 42%. That's before any other expenses you might have on a monthly basis. And let's say this qualifies because in this case, maybe the cap is 45% that you can go up to. But now your payment is $3,640, which divided into 8,000 gives us a debt to income ratio of 46%. So the difference between this payment and the pre-approved payment could actually be the difference in you qualifying to buy your home or not qualifying. So for one, you can see the reason why your payment's different now versus when you were pre-approved, but more important than that, you should understand the impact on how this can affect your ability to qualify for a home once you find it.